Welcome to the latest edition of Fundamentals, and this time around I'm going to take a topical look at the actively managed Artemis European Opportunities Fund. The lead fund managers are Mark Page and Laurent Millet, and between them they have over 30 years of investment experience. Their mandate is to generate long-term capital growth from their £364 million portfolio of stocks, which principally hail from Europe's stock exchanges, excluding the UK. Their focus is on high-quality names, but only those that come at a reasonable price, though I should say that the fund managers are not wedded to any one particular investment style, as they try to generate consistent, though not aggressive, outperformance of their benchmark index over time. The portfolio is built bottom-up, and Page and Millet keep things pretty tight, holding no more than 60 names in their portfolio at any given time. As I sit here, the largest portfolio positions include German chemical and life sciences giant Bayer, Swiss drug developer Novartis, German software player SAP, Scandinavian financial services specialist Nordea, and Danish pharmaceutical stock Novo Nordisk. By sector, financial services, industrials and healthcare are the three biggest sector exposures at 20%, 19% and 15% of the portfolio respectively. That's just over half in total. By contrast, there is a 1% weighting towards energy and just 2% in utilities, as we can see here. To provide a little context though, the biggest underweights in the fund are energy, banks and consumer staples, the last named on valuation grounds. By country, France, Germany and Switzerland are the three biggest exposures. Large caps currently represent just over 60% of the assets, mid caps just over a third, with small and micro caps just under 5%. The fund is eligible for SIPs, ISAs and dealing accounts and currently comes with a relatively lowly historic yield of 1.4%, which is the result really of the focus on capital growth. That said, Artemis European Opportunities does come with income units where dividends are paid out, though on this occasion we are discussing the accumulation units where dividends paid are automatically reinvested for advisors and clients. The ongoing charge figure is 0.85%, so advisors and clients do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund does come with a 5-star ranking from Morningstar. So, those are the mechanics. The question to address next is why could advisors and clients consider this collective for portfolio inclusion right now? And I think there are three perfectly feasible reasons. The first is that Western European stocks are doing well. The Eurozone economy continues to surprise on the upside, unlike that, say, of the USA, where President Trump appears to be making more progress on Twitter than he is in getting legislation through Capitol Hill. As we can see from this graphic, in sterling total return since the 1st of January, Western Europe is the second best performer of the major geographic regions, lagging only Asia ex-Japan and beating the UK, US and Japan pretty handily. The second thing potentially in the fund's favour is the European Central Bank, which continues to move heaven and earth to keep the Eurozone project on the road. Under President Mario Draghi, the central bank seems in no rush to raise headline interest rates from zero and continues to run a quantitative easing scheme of €60 billion a month. Low returns on cash, low yields on bonds are driving investors towards European stocks, just as we saw happen in the UK, US and Japan. And the third possible reason is the fund's own performance. This chart shows the performance since inception in 2011, and the last 3 years' returns are good enough to rank the fund in the top quartile, or 25%, out of a field of over 120. Now, this is not to say Artemis European Opportunities will suit every advisor or client. The absence of a decent yield may put off some, and the role of the European Central Bank is obviously a current source of strength for the European equity market, but that obviously therefore begs the question of what would happen if Mr. Draghi were to turn off the monetary taps, end the QE experiment on schedule in December. Note also that the euro currency has started to strengthen, especially against the dollar. A really strong currency could start to dampen earnings growth and potentially crimp European stocks' performance, especially as they've already done so well of late. For the final graphic, we can see that Germany's DAX index, for example, has already slipped to a 3-month low amid such concerns. So, advisors and clients must therefore do their research on Artemis European Opportunities to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching and I look forward to seeing you next time.